Hey everyone, welcome back to Corporate Decoder. Today we're diving into Brilliant Earth Group's latest financial report, and let's just say their numbers might have you re-evaluating your sparkle or maybe just your investment strategy. Seriously, some of these results are more surprising than finding out your favorite diamond is lab grown. And hey, if you like your corporate insights unfiltered and without all the boring lawyer talk, make sure you hit that subscribe button. If you want to chat about these numbers with other finance enthusiasts, join our Discord community. It's linked right below. Alright, so Brilliant Earth Group, known for its ethically sourced jewelry, dropped their quarterly report and it's a mixed bag. They are a company trying to shine in a tough market, and these financials show some of the challenges and triumphs they're facing. Let's jump straight into the numbers. Looking at their balance sheet on June 30, 2025, we see they had about $1,033 million in cash. That sounds like a lot, but then you look at their inventories, which jumped up to almost $48 million. That means they're holding more stuff, more diamonds and jewelry, which ties up a lot of cash. Now, for what everyone really cares about, the sales figures, for the 3 months ending June 30, 25, net sales were about $139 million. That's up a bit, around 3.3% from the same time last year. But here's the kicker. Even though they sold more, their average order value, or AOV, dropped quite a bit by over 12%. This means they're selling more items, but each item is cheaper on average. Think of it like selling more pieces of costume jewelry instead of engagement rings. This lower average order value really hit their gross profit. Gross profit for the quarter actually went down by almost 1%, and as a percentage of sales, it dropped by about 2.5%. Why? Well, they're blaming higher gold costs and tariffs. So even though they're selling more units, they're making less profit on each sale. That's never a good sign. Meanwhile, their operating expenses are going up. Specifically, general and administrative costs increased by about 8% for the quarter. They say this is due to more staff, higher rent, and other office-related costs. So they're spending more money to run the business while also making less profit per item sold. This squeeze on profits is really showing up in their profitability metrics. Their adjusted EBITDA margin, which is a way to measure their core operating profitability, dropped from 5.2% last year to just 2.9% this year for the quarter. That's a significant drop, meaning their underlying business operations are becoming less profitable. The full 6-month picture is even tougher, with adjusted EBITDA margin falling from 5.2% last year to just 2.9%. That's a substantial decline, showing a real struggle to maintain profitability. On the bright side, the number of orders they're fulfilling went up significantly. Total orders increased by over 18% for the quarter compared to last year. This shows that their marketing and sales efforts are driving more customers to buy, even if they're buying less expensive items. It's like having a bigger crowd at a store, but they're all buying cheaper accessories. Now let's talk about what the company is doing with its own stock. They've been buying back shares, acquiring over 41,000 shares in April and another 41,000 in May for around 150 cents per share on average. While buying back stock can sometimes signal confidence given their shrinking profit margins, it makes you wonder if they have better uses for that cash. Let's look at their debt situation. They have a credit agreement with Silicon Valley Bank. As of June 30, 2025, they had about $34.8 million in term loans outstanding. Interest expenses have gone down, which is good, mainly because they made some significant principal payments on that loan in May. And get this, even though this report is for June, they actually paid off that entire term loan and ended the whole credit agreement in early August. That's a pretty big move and will certainly reduce their interest expenses going forward. It signals they're trying to simplify their financial structure and reduce their debt burden. But here's something really interesting. Just after the end of this reporting period, in early August, the board declared a special cash dividend of 25 cents per share. That's going to cost them about $25 million. It's unusual for a company struggling with profitability to pay out a special dividend, but perhaps they're trying to reward shareholders while they still have some healthy cash reserves. There's also a mention of something called the Tax Receivable Agreement, or TR basically. When certain owners exchange their ownership units for stock, it can create tax benefits for Brilliant Earth. Under this agreement, they have to pay out 85% of those savings to the original owners. As of June 30, they had recorded about $8.3 million in future tax benefits and a corresponding liability of about $7.8 million. This is a significant financial arrangement that will impact their cash flow in the future. Now for a bit of a red flag. They've admitted to a material weakness in their internal controls. specifically with their IT systems. This kind of language is serious. It means there's a significant chance that errors in their financial reporting might not be caught. They're working on fixing it by hiring new IT staff and improving procedures, but it's something to keep an eye on. It suggests that their rapid growth might have outpaced their internal systems' ability to keep up with rigorous financial controls. And on a more personal note, their chief financial officer actually terminated a stock trading plan in May. This plan was specifically set up to allow him to sell company stock, and its termination might mean he's looking to sell shares outside of that structured plan, or perhaps his outlook on the stock has changed. So what's the takeaway here? Brilliant Earth is managing to boost sales volume, which is a positive sign of customer interest. However, they're doing so by selling cheaper items, leading to lower average order values and a significant hit to their profitability. Their gross margins are shrinking and their operating expenses continue to climb. While paying off debt and declaring a dividend are moves that can sometimes signal strength, they happen alongside these concerning profit trends and IT control issues. It feels like a company growing its top line but fighting hard to maintain its bottom line. They're certainly facing headwinds from rising costs and a shift in what customers are buying. What do you think about these numbers and Brilliant Earth's strategy? Let us know in the comments below. If you found this breakdown helpful, give us a thumbs up. And for more deep dives into company financials, make sure you subscribe. Don't forget to join our Discord community through the link in the description. It's the best place to keep the conversation going. Thanks for watching, and we'll see you in the next video.